Hey traders, Raghee here, and in this free recap video we're going to talk about just a general rule right now in the market as we get into any kind of FOMC event, whether that be the minutes, the meetings, or even events. Today we had minutes at 2 p.m. and the rule is this, and it's pretty simple. Don't be short going into minutes. Right now we have a very concerted effort by the U.S. Central Bank to communicate to the market, the stock market specifically, that we are here for you. We're not going to let the stock market fall. That was the Powell pivot on January 4. And look, they finally got the moves to this dance down, right? And that they're going to stick with it. So even though in some ways this morning the market might have seemed a little bit lethargic on the open, and we might have seen the markets meander and chop about, you know, one of the things that we kind of ended the morning chat with was, hey, whatever is happening, be very cautious of shorts, because as we get into 2 p.m., there's a pretty good chance that we're going to continue to see a little bit of strength. And certainly the market took the scenic route to get there, but you'll notice the market sunk down again around 2:30 and then rallied right into the close. And that's really the idea here. Is there a lot of organization? No. Is there necessarily a great clean intraday day trade? No. But when you're looking at the overall trend of the market, let's step out to the daily time frame of, say, the S&P. What we continue to see is the market pulling back, and it's supported by the wave on pullbacks. And guess what? If we were to pull back again, look, I don't like the macroeconomics of this market. I don't at all. I think this market is being supported by one thing and one thing only, and that is Jay Powell on January 4. There's very little else. And people can disagree with that, and that's fine. But you can definitely see that once Powell put his, the power of the central bank and the pause into the market, it's been a very different narrative, despite continuing contraction of GDP and other markers that would be signs of economic health. So what I want to keep in mind is, at this point in time, the market says, as one of our members said this morning in the chat room, in Powell we trust. And on days where Powell can communicate and recommunicate and redrive home that the central bank is going to pause and that they're data dependent and all these other things, for now the market's going to construe that as a reason to stay long stocks. And that means we stay long that NASDAQ, the S&P, NASDAQ mostly, S&P secondarily, for sure. You'll notice I'm leaving out the Russell because it's choppy at the moment, so be very careful about trend following buys. We don't have a trend. And in the Dow, well, we'll talk about this a little bit more. How come the Dow isn't participating? Right now I have one word, and that word is Boeing. We continue to be short Boeing with puts. We'll talk about that a little bit more in the premium video, but for now, avoid the Russell because the structure isn't there. Avoid the Dow for now because of Boeing, and we've been avoiding the Dow since the beginning of March because of Boeing. And just remember that when the market returns to sort of its high beta, high Momo ways, it's going to beeline to the NASDAQ and the S&P. So that's what we have right now. What's the takeaway? Don't be short the market when you've got FOMC minutes, meetings, or specifically Chairman Jay Powell events, because he is going to continue to reiterate what the stock market wants to hear, which is the water's fine, come on in. I'll see you in the next video.